Welcome back to B-Grade Economics Road Trips. This is Nate. Covering some basic market activity. We saw the NASDAQ come down and retest off of a breakout. We saw the S&P 500 and the Dow Jones continue to fall as well. Obviously, risk-off assets are beginning to read the room. And the room is basically a mixture of U.S. banks, CEOs coming out and saying inflation is high. What does that mean? Well, the banks are influencers who obviously follow the Federal Reserve, and the Federal Reserve and all the other news sites, CNBC, Forbes, they're all saying that inflation is a big issue. The problem is that these companies and organizations are coming out saying inflation is an issue is because they're setting the stage to allow the Fed to taper, because the stock market would not otherwise take or accept a taper. If they were to taper and there was not high inflation and they were simply going to unwind their balance sheet, it would cause a drop in the stock market, and the Federal Reserve and the current administration would be blamed for poor monetary policy. Since the new variant that is out right now is not causing a massive issue or disturbance, while it is highly spreadable, I think it's like 4.5 or 4.2 times as contagious, it is extremely low on its danger level, like hospitalization and death rate. And so this allows them to continue on the news and the narrative, we need to taper, we need to taper, we need to taper. Now, a lot of people have said the Federal Reserve is in a rock and a hard place. They cannot taper because if they taper, bond yields will go up because they will no longer be creating yield curve control through asset purchases, and that will cause risk-off events, which will cause a market crash, and that will cause low jobs, which are already in a low unemployment environment. The other side of the hard place, or the rock, is that if the Fed continues quantitative easing, we know that it is inflationary. We see the evidence that it leads to lending into the real economy through banks and investment firms that are utilizing it as a reserve in order to back and fund other loans and purchases. And so the speculative mania that comes with low bond yields leads to purchases in the NASDAQ and other places. When that bond yield unravels, historically, certain things happen. When the bond yield goes up, risk assets go down. For the past 10 years, Bitcoin has rallied in conjunction with a rise in bond yields, and it's hyper responsive right now. Gold has also rallied as bond yields go up when the productivity and economy in the stock market are down, but it does not tend to go up when bond yields rise and inflation is low. It goes up when bond yields rise and inflation is high. In other words, it's responsive to inflation despite the bond yield. So what does that all tell us? Well, a couple things have to happen. We are at the highest level of margin debt we have ever been at in history. We have the highest inflation, theoretically, that we've ever had in history if you use the same measures that we used in the 1970s. And we have a massive bubble in the tech stock market. I don't care what certain investors tell you, the valuations are off the charts and out of control. They might tell you that it's forward growth, but that's the whole point of a bubble, is expecting growth that isn't yet visible or able to be completely proven or will play out the way that you expect. So we're going to see an unraveling of this margin debt in order to avoid the crash as speculation begins to die. However, when the bond yields go up, the problem will be inflation. At first, you'll see deflation of asset prices. But the deflation will lead to another event where the Federal Reserve or the government, so either fiscal or monetary policy, will have to come in and start protecting jobs, because as the speculation goes down, some of the less essential jobs that are created by excess money availability causes companies to begin to unwind their debt and their risk. And so they'll start to reduce their total employed force, and that will cause unemployment to spike, which then again causes inflation, both through low productivity and through the money printing due to unemployment claims. This will continue on this trend, and we may increase what we're handing out. And so I just want to prepare people that you're going to first see, if they do in fact taper, you're going to first see deflation and bond yields drop, because the purchase of bonds is going to increase and the selling of stocks is going to decrease or increase. After that, the inflation effect is going to cause bond yields to rise, because people who are holding bonds would rather get in on a trade. But the problem, because the bonds are yielding a negative real yield, but the problem is that negative real yield will exist everywhere else that has a valuation, because again, the economy is starting to fall down. And since the economy starts to fall down, the place to go is monetary assets. But since the dollar and the bond are bad, the only other option is, by Cantillon effect, gold, silver, and potentially Bitcoin. So Bitcoin has that speculative portion. It has never done this before. I will make that very clear. The speculation is that if inflation persists and bond yields rise, Bitcoin has never experienced that event in a bad economic environment. It's never been in a bear stock market. It's been in volatile markets, but it's not been in a bear stock market. And so we are going to get a chance to see whether or not it holds up. I think that the long-term buyers, and I will make a very long video explaining all of this, are going to defend that line. And once that deflationary impulse ends, the inflationary impulse and the need to seek yield will start to drive a change in the way people invest. There will be a rise in gold. There will be a rise in silver. These are inevitabilities by fundamental consequences of the Cantillon effect. And the only vote that the Federal Reserve and the government get is if they allow deflation to just simply continue. But if they allow that, they're doing a very hard way to get there. They are jumping off a cliff to avoid a fire via a swan dive. And if they do not do something to release a parachute via money printing and saving people for unemployment and whatever, and repeated quantitative easing, they're going to get fired. There's going to be anger. The cost of living will be up by comparison to the average wages. And the American people probably don't have a stomach for it right now. This is a political environment problem. And much like 1929, they're going to want an answer. And it took 3 years from 1929 to get an answer. And that deflation led to a rise in the price of gold in terms of purchasing power, but the dollar was tied to gold at the time. Now you're going to see the other way. The dollar may even increase in purchasing power, but it might not outpace gold. It probably won't outpace gold. If production does in fact slow, and I don't think it will really completely collapse, but if it does in fact slow, then silver won't rise as much, but because it's affordable, $2,000 ounces of gold versus $30 ounces of silver, for less than $30, you're quickly brought to the assumption that people who are just trying to make it by into a form of savings they trust are more likely to buy something like silver. But the production, if it continues, especially if it's through fiscal policy, will begin to be consumed in two ends of the spectrum, the investment end and the industrial end. And that one, gold doesn't have an advantage. So if industry continues while inflation continues, then silver is going to take a very massive win there. The U.S. bond market is the largest security market in the world, and so when it unravels, it feeds a massive amount of money into other systems, and so there is opportunity in other places and speculation for all of these to rise at the same time. So I would just be on the lookout for these next plays. You're going to watch some very serious volatility if they do in fact taper, and they taper very quickly. Watch how the market actually responds to it and what they say versus what they do, because they may not actually unravel their balance sheet the way they claim that they are going to. Thanks for watching.